consider this a professional courtesy.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. It's been an interesting weekend. I had a few listing appointments this weekend that were very revealing. I had a lot of contacts over the last week that have been kind of interesting. We'll talk a little bit about that. I always like sharing the ground truth in terms of what's going on. And of course, my ground truth may not be your ground truth. It's always important to get plugged in with your local marketplace to figure out what's happening where you are. I know I have a lot of real estate agents who listen to the show, and you should be. I mean, part of your daily routine, and I do mean daily. I don't just mean once a week. You should be really plugging away at what's going on with your local data and sharing that with your clients who are investment minded. Be that resource, right, for investors out there to get good info. Okay. Best ways to reach out. Head on over to therebelbroker.com. For those of you who've been around for a super long time, you'll realize that it's a completely different website than what you're used to. The good news is you'll be able to get access to all the old shows. You can do a search at the top. Everything's wonderful. Layout's a little bit different, though. If you want to send along an email message, you'll see a bunch of icons at the bottom of the header graphic. They all do what they indicate, right? So the one that looks like a little letter is going to send me an email. There's links there to join the Rebel Underground. There is also a link there to take the survey to support the show, which is a great thing to do. If you're a brand spanking new listener, do that. Because in addition to helping the show, you'll also be putting yourself on a list to win a $50 Amazon gift card. And we do a drawing just about every month to give one of those away. And the great news is, even if you don't win this month, you know, for as long as we're doing this into the future, you're still in the drawing for that $50 Amazon gift card. So head on over to therebelbroker.com, check out the button to the right. It says take the survey to support the show, and you're all set to go. I did do the drawing on Sunday to pick a winner for this month. Have not emailed that person yet. I literally just got it done. So I haven't had a chance to send that person an email yet. So congrats to that person. As soon as I send out an email and get a verification, we'll be ready to go with sending them that $50 Amazon gift card. So congrats to that person, and good luck to all of you who have yet to win, and congrats to all the other folks who've won over the past year or so, to the tune of, I don't even know at this point, 700 something, $800. I don't even know where we're at. But anyway, we'll continue on doing that. And I do appreciate those of you who go to the trouble of answering that small handful of demographic questions just to help the show grow. All right. So as I mentioned, we're going to talk a little bit about ground truth. We'll do that in a second. But first, I wanted to hit on something that I think is a super big deal. Particularly for a certain segment of folks who do flipping. Now, I have a few investors who love doing the luxury end of flipping. And typically, and that's not necessarily a bad idea. I mean, we have some data here that indicates it may be something you want to temper or tone down. And here's the way it usually goes, right? You find a property that is in relatively tough shape in a neighborhood that really either has that range of valuation where luxury homes are not terribly uncommon, right? Because you don't want to be someone who buys in a relatively middling area and then you're the most expensive house on the market, right? That's not what you want to do. You want to find a home that is not living up to its full potential. That's typically what you're looking for in a flip, right? But you want to do that in a neighborhood where those luxury prices are being achieved by some. So that typically means you're buying a home that's got some challenges, needs some remodeling, needs some updating, those types of things. And of course, that also is something that relies on market strength. And one of the most important pieces of data that you're going to need in your area is, where is that wall at? At what point does pricing tend to come to a grinding halt? And this also kind of comes into mind because these are numbers that I was going over this weekend. I went on a few different listing appointments, and one of them fell into this sort of interesting borderline where if you did a pricing strategy at one level, there was a good possibility that your days on market could be literally 100 days. And if you went the other way, which was I was suggesting, it could be less than 30. So, you'll find yourself in that position. So what I'm suggesting is you as an investor need to really calibrate yourself to what you're doing and what the market is doing with what you're trying to provide. And in this case, if you're someone who is doing investments where you're rehabbing properties to get them up to a luxury level, you need to be really sensitive to where the sweet spot is for that, because we're seeing more and more data that indicates that we're seeing a compression. Let me explain what I mean by a compression. We had a period of time where luxury homes of all kinds were just flying off the shelves, right? They were seeing the same low days on market as a lot of other properties were. But what we've been seeing in the past few months, at least in my marketplace and in many markets across the country, we've talked about it happening in New York, we've talked about it in Miami, we've talked about it a little bit in LA, where the activity at the high end is compressing. Folks are being driven downward in the price range. So that $3 million, $4 million house isn't selling in 30 days, right? The $2 million house isn't selling in 30 days. And I ran some very interesting numbers for a listing that I went on this weekend where that was really clearly demonstrated. And we can talk about that in a second. But before we do, I want to talk a little bit about an article that I came across that originated with Realtor.com but got republished or reviewed sort of by the folks at riskmedia.com, talking about how luxury is softening as the supply is now topping the demand. So what this is really an equation of or an example of is what we've talked about on this show, a point at which the demand and supply either go into balance or the supply actually goes beyond demand. And it's interesting to see. And when people think that we're in this gangbusters market where things are just going to keep going, which is a lot of the same stupid stuff that people were saying just right around 2005, 2006, people were saying the same thing. Suddenly everything starts to take a turn. And it's always interesting, as we've talked about in previous shows, to have segments of the market that you pay attention to, where you're looking for those pivot points. Again, right? Pivot points. That should sound familiar. We've been talking about those. We talked about, are we seeing a pivot point in New York when we were talking about the data from there last week? What are we seeing in California? What are those pivot points and what's causing them? Are they real estate focused issues, or are they outside of real estate that could then influence real estate? There are definitely real estate focused things happening in New York, and I think there's outside real estate things happening in California that are potentially nudging things in different directions. And we've talked a lot about those. But right now, we've got an interesting supply side problem, because what have we been building the most of? In addition to those multifamily units, which are basically apartments, right? So we're not really satisfying single family residential desires in what we've been building primarily. But when we were building, or when we are building single family residential homes, where have those homes tended to be? Well, here in California, because of the extensive cost associated with building properties, it simply made more financial sense to build a luxury home. So we are there. We have reached the point in the luxury market where now there are enough homes out there to satisfy demand. So what happens? Prices start to soften. So this is going to be a segment of the market I really want to keep an eye on, particularly because as it pushes down, as we see the compression coming down in the marketplace, it's likely to affect me, right? I happen to be lucky enough to have bought in an area that's considered sort of just bumping up against the luxury market. Right now, the barrier seems to be in my marketplace around $1.1, $1.2 million, where after that, suddenly the time it takes to get a home sold just kind of goes through the roof. But let's focus on the data here from Realtor.com. Quote, according to Javier Vivas, Director of Economic Research for Realtor.com, although 2017 was another strong year for the luxury housing market, it was once again outperformed by the U.S. market overall. Now, according to data from Realtor.com, the luxury market's entry-level price, or the top 5% of transactions based on sales price, grew by 5.1% in 2017, behind the 6.9% growth the market saw overall. Average days on market in luxury also lagged 116 days compared to the general market 71 days. Now, let's inject a little ground truth because those numbers are absolutely reflected in what I'm seeing locally. So let's approach this in a way that I think is easy for most of you to get a handle on. And the best way to do that is to identify your ideal property, right? And what have I always said? In my local marketplace, 3-bedroom, 2-bath, that's the core, right? That's the soft, chewy center of what everybody wants. So do a search on that. Pick your city, make it as broad as you like because you want broader numbers. Your submarkets are a little bit less important at this point. So go ahead and do that search. And I did that for Morgan Hill, and I did it only for active homes. So I'm acting like a buyer, right? Now, in my particular list, what I see is a listing of properties that are currently for sale and how many days on the market each of them has. Now, another really great list, which is one you'll need to get with your real estate agent, is the number of homes that have sold. Now, this is a way for you to do this without actually having to talk to a real estate agent. You can simply do a search. You could do it on Realtor.com. You'll be able to see the days on market. Now, the way I'm viewing it is super easy because it's just a table of data. But if you apply a little market knowledge to how long some of these properties have been on the marketplace, you definitely spot the trend pretty quickly. But you have to remember that these are actives, right? So you're going to find some that are super low. But let me lay it out for you. What I've done is I've put these properties in, and I am sorting them by list price, by how much they're currently listed for, and then looking at how long they've been on the market. And because I tend to visit every home that comes on the market in my marketplace, there are some of these I know I should throw out immediately. Like, for instance, there's a property at the bottom of the list that's been on the market for 120 days. So it's the cheapest home, but it's been on the market forever. Well, if you know about it, you know that it's way off in the hinterlands. It's completely off grid, and nobody will loan on it, right? A bank that's going to do a conventional loan normally at least requires power to be coming to the property, right? So it's real tough. There's only one lender I know of who will lend on something like that. I've sold a couple of off-grid properties, and it's real tough. And it's also a great way to get a deal if you're someone who wants to get an off-grid property. But once you eliminate that, and once you eliminate some of the others that are artificially challenged, what you tend to see is that everything under about 1.1 million bucks is tending to be no more than 40 to 60 days on the marketplace. Above that, we start seeing 124 days, 159 days, 262 days. And remember, these are all homes that are still available. They're still on the market. There's a $1.7 million home that's been on the market for 260 days. So it's literally been out there, people trying to get it sold throughout the biggest boom ever. And whoever has this listing, they're clearly not analyzing this property on a regular basis, because I'll tell you what, given the trends I've been seeing and what sales prices have been doing, I would have aggressively advised my client to change their pricing strategy by now, simply because now they're losing it. Now they've sort of capped out. They've hit this high point now, and there's a really good possibility it's going to be difficult to get this thing sold. Particularly since there's also likely at the luxury market level, because of the news we're hearing, that there'll be more competition out there in terms of more folks trying to get their home sold. All right, so in addition to that, now when we look at data that's much easier for a real estate agent to provide you, which is homes that have sold. So take a look at those numbers, get these numbers from your real estate agent, and again, sort them by the amount the home sold for, and do a side-by-side. You can tell activity levels of various homes in addition to just seeing how many days on market, but when you compare the list price to the sold price, what do you see? At what point do you start to see the home selling for more than list price more frequently than you see it selling for less than list price? Now, in the list I've pulled up, again, I've talked about the $1.1 million wall, and that tends to be the case here, right? So we start to hit 1.1 million bucks. In fact, this is a home that's in the same development I'm in, where they originally priced the home at 1.125 million bucks, and it ended up selling for $1,020,000. Here's the dividing line. This is right where it happens. Home listed for $998,880, sold for $1,010,000, right? So when you start to see trends like that, call that a line, put a line there, and you can figure out from that, it's harder to get stuff sold above this line than below this line. That's just the activity level, right? It's the amount of activity. So use those numbers to your advantage. And also, once you get beyond this sort of right at the cusp of $1 million, suddenly things start to change. You get a few that are ending up selling for a little bit over asking price, but then it starts to be predominantly at asking price. Then suddenly it's 10,000. It's 10,000 below asking price, or 9,000, which is I'm seeing 3 or 4 here in a row. And here's a couple that I know these two actually homes myself because I visited both of them. They were freaking amazing. But you can also sort of link this with the days on market. And the higher we go, we typically get higher days on market. We tend to see properties selling for below asking. 1.2 ends up selling for 1.1, 1.199 ends up selling for 1.183, 1.249 ends up selling for 1.2. 1.18 ends up selling for 1.0. Just you start to see these trends. And so as an investor, you need to figure out where you need to sit. Where are these sweet spots? Because the key here is to minimize your holding costs. You want to get the price you need to get to make it make sense for you, but you also need to have enough buyers out there that you have the highest probability for this thing to sell quickly, and potentially, if you're lucky, for multiple offers. Okay, so those are 2 ways for you to really sort of focus in. Now, let's talk a little bit more about this article. We'll do that in a second, but we're going to take a quick break, so don't go away. We'll be right back. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner, broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. We're talking about finding the sweet spot for investors, and also extrapolating what else we can get out of this. Now, if the numbers we're seeing here and the stuff being reported by Realtor.com holds any water, and if it's true in your local marketplace, what's the overall implication here? Well, if you're someone who's looking to buy at the luxury level, you may find yourself in a position where you're going to get some better deals. Things where that you might start looking for is brand new construction that if you were already plugged in early, like for instance, I get email, and you can do this yourself. This is not a real estate agent specific thing. If you know who the big builders are in your local area, go to their website and start subscribing to their newsletter, because typically they're going to announce new construction, but with a pretty good amount of time lead so that you can keep track of it and keep track of that stuff. Find out how much were they saying these units were going to cost when they were done, and see if you don't notice a trend of these homes actually coming out a little bit lower than what they originally planned. Another thing is to keep abreast of how fast are they selling. Are they getting pre-sold? Are you tending to find that they're not all sold by the time the developments are actually done? Is it one of those situations where they're actually having to show these properties once they're built? Now, the last time we had a downturn, the luxury market was one of the top areas that got hit the first. I remember at the time, I was working with an office at the time, and we had been delegated responsibility for selling some mainstream properties and that were just not quite luxury level. They were probably a step and a half below luxury level. But then we also had some properties that were at that luxury level. And man, could you see it? The change was happening relatively quickly, but we felt it at that luxury level first, and eventually it pushed down to the level just below luxury. And of course, the entire market kind of took it from there. But these are all things you'll be able to see as market trends in your areas. And suddenly you're going to find yourself in a position where these luxury homes are starting to sport prices that are less and less luxury, giving you more and more flexibility to potentially get a good deal on one. Now, you'd have to get most luxury market stuff. The math doesn't work if you're an investor, right? If you're someone who wants to live in one of these style homes, there may be an opportunity for you coming up. But normally, if you do the math, you figure out the likelihood of vacancies, you figure out how much you could charge for rent, the odds are you cannot rent it for what your payment would be in most marketplaces. That's not always true. In fact, rental is still super strong. So let's say you're someone who does like doing the luxury remodel thing. A good strategy for you might be go ahead and get that challenged property, give it the updates, and then rent it. And you might still be able to find yourself getting a good return on investment given that scenario. But of course, it's math, right? So when we're talking about investments, it's not about how emotionally attached you are to anything, but it is just about you doing the math to figure out if it makes sense for you. Okay. Age of inventory, according to again, continuing with this evaluation of the Realtor.com article, quote, age of inventory in the top 5% of the market slowed significantly over the last year, a telltale sign that supply in the luxury sector continues to outpace demand. Much of this slowing can be attributed to a wider selection of luxury homes for buyers and increased uncertainty over the last 12 months. Now, I think it is key that we're taught that the first point is the key. The selection of luxury homes is up. The number of luxury homes is up. We've been talking about on this show for over 2 years how they're overbuilding on the luxury end because the math made sense. Well, now that math is making less and less sense. So builders are going to have to adapt, and this could be an absolutely fantastic development for folks who aren't at that luxury price point, who just want to find a decent home and don't have money to spend millions of dollars. On average, $1 million homes on the market accounted for more than 77% of all homes listed last year, increasing 3.9% according to data from Realtor.com. The median list price was $1,307,000. The median sale price was $804,000. These are exceptions to the trend. The San Francisco Bay Area, for one, and Seattle, in addition to mainstays like Hawaii. The fastest growing luxury markets are by sales price, according to Realtor.com, are number 1, Maui, Hawaii. Number 2, Eagle, Colorado. Number 3, Kings, New York. Number 4, Kauai, Hawaii. And number 5, Hawaii, Hawaii. For those of you who know, I have an investment property in Hawaii. Mine isn't on any of those islands. Mine's on Oahu. So the priciest, and this is right in the heart of where I am. Number 1 is New York, $5,284,000. San Mateo, California. That's up near where I first started in real estate, $3.37 million. Marin, California, which is way North Bay, $3.288 million. San Francisco, California, $3.212 million, and Eagle, Colorado, $2.89 million. Interesting that Eagle is on both lists. Number 2 in terms of fastest growing, and number 5 in terms of the priciest. So those are the numbers coming out. I think what this should kick off for anybody out there, whether you're a buyer or you're an investor, if any of your interests cross over into the luxury market, it's time to reevaluate. I would call this potentially a pivot point where the top end of this marketplace may be not there anymore. It may be a situation where you're likely to see stabilization or even a drop in value, given the fact that there are still lots of still, at least in my area, there's still lots of construction that's at this luxury level that has yet to come on the market. It's going to be coming on the market in the next 6 months. So if that's true in your area, this could absolutely be a major influence for you. Okay. So let's talk a little ground truth for a second. One of the statistics we talked about last week was this idea that there were more sellers out there comfortable with the idea of potentially listing their house in 2018. We talked about how that would be a great thing, seeing the supply increase, however it increases, at the core price point, which is, I usually, in my mind, anything that is whatever the average is in a community minus 20%, anything in there is a nice sweet spot where a lot of people need to buy, right? And you're not seeing a whole lot of new construction coming in there, but I've talked to quite a few sellers over the last week who are interested in discussing the possibility of doing this in 2018. So I've got one property that's going to be coming on the market probably in March. These folks are out. These folks are leaving the state. But I've got several others that I've talked to that are also looking at the same kind of plan. They're sort of putting things together, and I have tentative listings from several folks. And at this point in 2017, I wasn't seeing this level of interest in terms of the number of people who are reaching out. Now, a lot of my business comes from referrals. A lot of my business comes from some advertising I do online that puts my contact info in front of a lot of different people on a lot of different websites. And I'm also getting folks contacting me through that. So I'm getting, and what's really interesting is the number of folks who contact me via that particular online advertising is usually, one per quarter. It's not a big one, but it is one that tends to generate listings. It's aimed exclusively at people who want to list. It's done better in past years. And I think it's understandable that it would not be as productive given the hesitancy on the part of a lot of folks to list their properties. But what I find interesting is that particular tool we're 7 days into 2018, right? And if I compare this quarter, the first 3 months of 2018 to the first 3 months of 2017, I've already gotten more leads on that online tool than I got in the entire first 3 months of 2017. I've already beat 2017 and I'm 7 days into 2018. All that should tell you the advertisement is exactly the same. Nothing else has changed. The number of people who see it is the same. Everything is the same, but the number of folks responding to it and clicking on it has multiplied by 3. That seems like an interesting thing to keep an eye on. We'll see how much that keeps going. Maybe it was just an odd right after New Year thing, but it's an interesting thing from a ground truth standpoint. What I'm seeing is a lot more serious interest in the potential option of selling your property in 2018. Okay, so keep that stuff in mind. I think these are all dynamics within the market that if we keep them in mind and let them sort of germinate in our heads with what our personal strategies are, can help us make better decisions. At least I hope that's the effect. As always, the goal here is to leave you with more tools, more knowledge, more useful stuff for you to navigate your real estate goals than time you invest to listen to the show. Hopefully we've achieved that today. Thanks again for listening, everyone. I do value your time. I'll talk to y'all next time.